In today's video, let's talk about the economy in the near future. Recently, we've heard a lot of predictions about the prices of gold, silver, cryptocurrencies, and oil and gas skyrocketing. One of the most notable voices in these predictions is Brandon Biggs, who claims that we are heading towards some serious financial changes. Some self-proclaimed time travelers have even gone so far as to suggest that other cryptocurrencies will soon match Bitcoin's current price of around $100,000. That might sound crazy at first, but on second thought, it doesn't seem so far-fetched. If you were told back in 2012 or 2013 that Bitcoin would eventually hit $100,000 after starting at just a couple of $100, would you have believed it? Probably not, but look at it now. Bitcoin has defied expectations, and it's not the only one. The question is, could other cryptocurrencies follow suit? The reason why cryptocurrencies increase in price so quickly is likely due to several factors. First, they're traded very often, 24/7, unlike traditional stock markets which only operate during set hours. The ability to trade anytime gives these digital assets a unique advantage in terms of liquidity and volatility. Second, cryptocurrencies are largely anonymous, which appeals to people looking for privacy in their financial transactions. But perhaps the most important reason is inflation. With the value of the dollar, pounds, and euros diminishing, investors are looking for alternative assets to preserve and grow their wealth. And that's where gold, silver, and cryptocurrencies come in. As inflation eats away at the value of traditional currencies, the value of these assets seems to rise. But what if the predictions about these assets going up in value aren't because they've suddenly become incredibly valuable, but rather because the dollar is rapidly losing its value? As the dollar weakens, other assets like gold, silver, and crypto will increase in value and can trade more into dollars, leading to price surges. So, what if Brandon Biggs and others are right? What if we're seeing a future where the dollar's value declines significantly, and everything else, assets like gold and crypto, rise in price simply because they're worth more in comparison to the dollar? If this is true, then we may be heading toward economic turbulence, and it's something we should pay close attention to. The current inflation situation. Now, when we look at inflation today, it's hard not to notice that prices are climbing. This is not just some temporary hiccup. It's part of a larger trend. Inflation, driven by a number of global factors, is showing no signs of slowing down. The US Federal Reserve has been aggressively raising interest rates to combat inflation. But even with these measures, prices continue to climb, especially in sectors like food, housing, and energy. One of the main reasons inflation is so persistent is that the supply chain disruptions from the pandemic are still ongoing. Despite improvements, bottlenecks in logistics, labor shortages, and geopolitical tensions, such as the Russia-Ukraine war, continue to cause price spikes. Energy prices remain volatile, and when oil and gas prices rise, everything else does too, since energy is a key input for production and transportation. Another reason inflation is so sticky is the tight labor market. In the US, businesses are struggling to hire workers, and wages have been rising as a result. While higher wages are good for workers, they also contribute to inflation. As businesses pay more to attract workers, they inevitably pass those costs onto consumers in the form of higher prices. This leads to a wage price spiral, where higher wages lead to higher prices, which then pushes for even higher wages. Why inflation is unlikely to go down soon? If you look at the labor market today, it's clear that wages are rising and employment is high. With such a strong job market and low chances of layoffs, it's almost impossible to imagine a scenario where inflation suddenly drops. These conditions only happen when inflation is high, and they further fuel the cycle of rising prices. It's a tough spot to be in. As wages rise, so do prices, which means we're all spending more to buy the same goods. And when you go shopping, it's hard to ignore how much things have gone up. The culture of borrowing money has only added fuel to this inflationary fire. Ever since the concept of using debt to fund consumption became widespread, it's almost as if people believe the economy must keep expanding. The idea that the economy cannot slow down and must continuously grow and borrow more has taken root in modern society. But this reliance on debt to keep the economy growing is what's propelling inflation further. The result is a bubble, one that's increasingly difficult to control. It's like building a dam to contain rising water. The more you build, the more pressure there is, and instead of letting some of the pressure out, we just keep adding to it. Eventually, it becomes too much to manage. But there's hope. This isn't entirely uncontrollable. If we look at history, we can see examples where inflation was brought under control through decisive action. President Ronald Reagan's administration in the early 1980s tackled high inflation head-on. With the help of Federal Reserve Chairman Paul Volcker, interest rates were raised dramatically to curb inflation. This caused short-term economic pain, but the tough decisions paid off in the long run. By the mid-1980s, inflation was under control, and the US economy entered a period of strong growth. However, the idea of price and wage controls, like what Reagan and Volcker did, would likely be met with fierce resistance today. Imagine if the government decided to impose strict controls on wages and prices to curb inflation. How do you think people would react, given how accustomed we've become to borrowing money and using it as if it's magic? Many would probably protest. People are so used to the idea of using debt to fuel consumption that price controls might be seen as a severe infringement on personal freedoms and economic liberty. Historical examples of hyperinflation and economic collapse. Let's take a look at history. Weimar Germany in the early 1920s is one of the most infamous examples of hyperinflation. After World War I, Germany's government printed vast amounts of money to pay for war reparations and recover from the war's devastating effects. By 1923, inflation was out of control. The German mark became nearly worthless, and people were using wheelbarrows full of cash just to buy basic goods. The country experienced severe economic collapse, and savings were wiped out. In Zimbabwe, during the late 2000s, hyperinflation reached catastrophic levels. The government printed money to cover its budget deficits, leading to inflation rates of an astronomical value in 2008. By the end of the decade, the Zimbabwean dollar was essentially worthless. People's savings were wiped out, and the country faced social unrest and a collapse of the formal economy. Venezuela has experienced a similar situation since the mid-2010s. Due to falling oil prices, political instability, and economic mismanagement, hyperinflation reached unimaginable levels, with inflation rates exceeding 1,000,000% in 2018. Prices doubled every few days, and the bolivar became practically worthless. People turned to foreign currencies or bartering to survive. The country's economy shrank, unemployment soared, and millions fled the country. Arguments for inflation continuing to rise. As we stand on the precipice of economic uncertainty, several factors suggest that inflation may not only continue, but intensify in the coming years. While many hope for a return to economic stability, the reality is that various interconnected global events are pushing inflationary pressures higher. Let's explore why inflation could rise further and the potential scenarios that could escalate it. Geopolitical instability, war, and escalating conflicts. One of the most immediate and potent drivers of inflation in recent years has been geopolitical instability. Consider the ongoing Russia-Ukraine war, which has already sent energy prices skyrocketing, disrupted global food supplies, and intensified the inflationary spiral. If this conflict continues to escalate or drags on for years, it could further destabilize global supply chains, particularly in the energy and agricultural sectors. For example, if the war extends to NATO countries, or if Russia takes more drastic measures in retaliation, such as cutting off natural gas supplies entirely to Europe, Europe's energy crisis could deepen, leading to energy shortages that would push prices up even more. If energy costs continue to soar, production costs for goods across all sectors, food, electronics, and manufacturing, would rise, passing on higher costs to consumers. Imagine if the Middle East tensions flared up alongside the Russia-Ukraine war. The price of oil could spike beyond $200 per barrel as conflict between Israel and Iran intensifies, pushing fuel prices to record highs. This could disrupt global trade, as the Middle East controls key shipping routes like the Strait of Hormuz, a choke point for oil shipments. With more countries being drawn into conflicts, especially if these conflicts center around resource-rich regions, inflation could rise to uncontrollable levels. Climate change and natural disasters, supply chain fragility. Another factor contributing to rising inflation is the increasing frequency of extreme weather events. As climate change accelerates, global agricultural and manufacturing systems will be further stretched. From droughts affecting grain production in the US Midwest to floods disrupting logistics in Southeast Asia, natural disasters will likely continue to disrupt the global supply chain. In the worst-case scenario, a series of bad harvests in the world's breadbaskets, like the US, Russia, and Brazil, could send food prices skyrocketing. In 2022, we saw the impact of supply chain disruptions due to the pandemic. But imagine if we face a future where crop failures, like a drought in the US, create global food shortages. In that scenario, food prices could rise sharply, feeding into wage price inflation, where workers demand higher wages to keep up with the cost of living, leading to a further increase in the cost of goods. Additionally, wildfires, floods, and hurricanes could destroy critical infrastructure, ports, highways, and factories, disrupting everything from oil production to the delivery of consumer goods. In such a scenario, supply chains would be so fragile that any localized disaster could trigger a global ripple effect of rising prices. The US dollar's decline. Global economic shifts. The US dollar has long been the world's reserve currency, but a growing de-dollarization trend is slowly chipping away at its dominance. Countries like China, Russia, and even Saudi Arabia have been moving away from using the dollar in international trade. China and Brazil, for instance, are exploring the use of their own currencies in trade deals, bypassing the US dollar entirely. If this trend accelerates and more countries adopt alternative currencies, it could undermine the dollar's value on the global stage, weakening its purchasing power. For example, the BRICS nations, Brazil, Russia, India, China, South Africa, are creating their own currency bloc to challenge the dominance of the dollar. If more countries shift away from the dollar, it could lead to a reduction in global demand for US currency, causing its value to drop. As the dollar loses its strength, inflation in the US would intensify as goods and services become more expensive for American consumers. The loss of dollar hegemony could lead to a situation where the dollar is printed in ever greater quantities to finance the US government's deficits, accelerating inflation further. This is also what Brandon saw in his vision. Rising debt levels, the debt bubble. The world's debt levels, both public and private, have reached record highs. In the US, the national debt has surpassed $30 trillion, and it's growing rapidly as government spending increases to address pandemic recovery, infrastructure projects, and military expenditures. While the government prints more money to cover its debt, the value of the currency declines. What if the US reaches a point where it can no longer meet its debt obligations without printing an unsustainable amount of currency? Hyperinflationary scenarios could unfold, where the government may resort to printing money to finance its debts, as Zimbabwe and Venezuela did in the past. This could lead to a sharp devaluation of the dollar, which would cause the cost of living to soar as prices rise uncontrollably. With the debt bubble already showing signs of strain, imagine a major economic shock, perhaps a global recession or another pandemic, that causes tax revenues to plummet while government expenditures soar. In this situation, the US government could resort to drastic measures like quantitative easing or even negative interest rates, exacerbating inflation and leading to a vicious cycle where the value of the dollar diminishes further, pushing inflation rates even higher. Technological disruptions, the rise of AI and automation. While artificial intelligence and automation are touted as future solutions to many of the world's problems, they could also create significant economic disruptions that lead to inflation. As AI continues to replace jobs across industries, the income disparity will widen, leading to social unrest. Governments may print more money in an attempt to support those displaced by automation, creating even more currency in circulation, which could drive inflation. Furthermore, as AI drives new industries and demand for resources like lithium, cobalt, and rare earth metals increases, the prices of these materials could spike. The manufacturing costs of everything from smartphones to electric vehicles could surge, raising the price of consumer goods and pushing inflation even higher. Imagine a world where AI-powered financial systems start pushing more people toward digital currencies, further diminishing the use of traditional money. As cryptocurrencies become more widely accepted, the demand for stable assets like gold and silver could increase, pushing up their prices significantly and further compounding inflation. This could set the stage for a future where the dollar is barely recognizable compared to other assets, fulfilling predictions of a significant devaluation, pandemic aftershocks, and future health crises. The COVID-19 pandemic showed us how vulnerable global economies are to health crises. But what if we experience future pandemics or even new variants of COVID-19 that disrupt the global economy again? If future pandemics result in widespread shutdowns or major labor force shortages, it could cause massive supply chain disruptions, as we've already seen with critical shortages in everything from medical supplies to everyday goods. In addition, if governments implement more widespread stimulus measures or lockdowns in the face of another health crisis, the result could be an increase in money supply without a corresponding increase in production, triggering more inflation. If central banks continue to inject money into the system without addressing underlying structural issues, the currency could lose value faster, making everyday life more expensive. In conclusion, the future of inflation is uncertain, but the forces that drive it, supply chain disruptions, energy volatility, tight labor markets, and expansionary monetary policies, suggest that inflation is likely to persist. If we're not careful, it could spiral into something much worse, like hyperinflation, leading to economic collapse. However, As history shows, inflation can be controlled, but it requires tough decisions, decisions that may not be popular in today's debt-fueled economy. If the visions of Brandon Biggs and others are correct, we might be headed for a future where the value of the dollar diminishes significantly, causing other assets like gold, silver, and cryptocurrencies to rise in price. But in the process, we may face an economic storm that could be hard to weather.